So how do we measure systematic risk? We use beta coefficient to measure this risk. Remember we said systematic risk depends on economic forces and market changes such as inflation and GDP. Well, beta measures how a security responds to movements in the market. And that's the formula to calculate beta. The covariance, remember the covariance between two variables measure how they move together? So the covariance of an asset with the market divided by the variance of the market. By definition, the market beta is always 1. So if we have an asset that has a beta or systematic risk of 1, it means that it has the same risk as the overall market. If it's less than 1, the asset has less risk than the market, and if its beta is more than 1, the asset has more risk than the market. But what is the market? The market is supposed to be this well-diversified portfolio that incorporates all asset classes: shares, bonds, property, gold, art, every asset class in the world. However, in reality, this portfolio doesn't truly exist. And that's why we use a share market index as a proxy for the market. So to estimate beta, first we decide on an estimation period. So we use periods ranging from 2 to 5 years for the regression in general, and on the return interval, whether it's weekly, monthly, or daily. Longer estimation period provides more data, but firms change. Shorter periods, on the other hand, can be affected more easily by significant firm-specific events that occurred during the period, like the dot-com boom or bust. So then decide on the return intervals, keeping in mind that shorter intervals yield more observation but suffer from more noise. Noise is created by stocks not trading, and biases all betas towards 1. Then you have to estimate the returns on that particular share, and then you have to choose a market index as broad as possible and estimate the returns on that index as well for each interval for the period chosen. The standard procedure for estimating betas is to regress stock returns, RJ, against the market returns, RM. So the model, the regression model RJ equal alpha plus beta multiplied by RM, where alpha A is the intercept and beta B is the slope of the regression. So after that, plot the points on a scatter plot graph, taking consideration that on the y-axis you plot the share return, so on the vertical axis it's the share return, and on the x-axis, on the horizontal axis, is the market return. And then you draw a line through the points using linear regression. You don't have to worry about this because the computer does all this for you. The slope of the regression corresponds with the beta of the stock and measures the riskiness of the share or the sensitivity of the share's return relative to the changes in the overall market return. The conventional approaches of estimating betas from regressions do not work for assets that are not traded. For example, the unlisted firms. This is because there are no share prices or historical returns that can be used to compute the regression betas. There are 2 ways in which betas can be estimated for non-traded assets. First, we identify comparable listed firms and calculate their betas and use these as proxies for the unlisted firm's beta. Or number 2, use accounting earnings, where we just regress the accounting earnings for the firm against the market index. This produces what is called an accounting beta. Calculating beta in Excel is easy. After we download the prices for the share and for the market and calculate the returns on both, we use the slope function to find the coefficient beta. So this is the function in Excel called slope. And remember we mentioned that on the y-axis it goes the returns on the share, and on the x-axis it goes the returns on the markets. Always remember this rule. It's very important so you don't mix up the rule, the order. So the result 1.3 is the beta, the coefficient of the regression. We said that the beta of the market is 1. Here we have the scatter plots of two stocks, Oroton and AGL, and we observe the lines have different slopes. Since Oroton has a beta of 1.4, when the market's returns 1 week moves 1%, then the return on Oroton moves in the same direction by 1.4%. It does this because Oroton is relatively more volatile than the market as a whole. The return on a high beta share like Oroton experiences dramatic up and down swings when the market moves. On the other hand, because AGL's beta is 0.4, less than 1, we can say that the return on AGL's shares moves on average 0.4 times as much as does the market return. AGL's volatility is only weakly related to fluctuation in the overall market. Most of AGL's risk is unsystematic and can be eliminated through diversification. Now that we know how to measure systematic risk, we can introduce the basic theory that links together risk and expected return for all assets. This is known as the capital asset pricing model, or CAPM, and this is our third method of calculating expected returns. This model has revolutionized the financial markets because it enabled investors to determine the expected return or the required return of an asset, whether you're talking about a financial asset like a share or a physical asset like a block of land. The CAPM is the model that allows us to calculate the discount rate, the R that we used in our share valuation formula. And this is the magic formula that allows us to calculate the return on any asset. It's just the risk-free rate plus the beta of the asset multiplied by the market risk premium. Remember earlier we said the risk premium is the extra return over and above the risk-free rate. Well, market risk premium is the extra market return over and above the risk-free rate. In Australia, by the way, the market risk premium is around 6 to 8%. For example, if IBM has a beta of 1.15, the risk-free rate is 5% and the expected return on the market is 12%, what would be the required rate of return for IBM? We apply the formula, and even before we do the calculation, we know that the expected return result will be higher than the return on the market, than 12%. Why? Because the beta of IBM is higher than the beta of the market. So immediately we know we should get a higher result than the market return. And indeed, applying the formula, we get 13.05% expected return. So by looking at the formula, we can see that the expected return depends on, number one, the pure time value of money, which is the risk-free rate, the reward for merely waiting for your money without taking any risk. Number two, the reward for bearing systematic risk, the extra return above the risk-free rate given by the market in addition to waiting, or the market risk premium. And number three, it depends on the beta of the asset, which is the risk of the asset. The equation of CAPM is represented graphically by the security market line, or the SML. It is an upward sloping line that shows the positive relationship between risk and return. The CAPM was developed to explain the complex behavior of security prices and is based on some very rigorous assumptions, among others being that the markets are efficient, All investors have the same information, no restrictions on investment, no taxes, no transaction costs. In effect, it assumes that markets are in equilibrium. If the markets are in equilibrium, the CAPM demands that all assets must be plotted on the security market line, which means that they are properly priced. In other words, based on each asset level of risk, we should receive the appropriate return. If an asset does not plot on the SML, it means that it's not properly priced. It means that it's under or overpriced, or under or overvalued. So if individual shares or a portfolio lie above the line, the expected return is too high. Shares are undervalued. They are cheap. Investors will demand to buy this and will bid the price up until the expected return falls. On the other hand, if shares lie below the SML, the expected return is too low. It means the share is overvalued, too expensive. Because the share is too expensive, investors will sell these shares, driving down the price until expected return rises and plots on the SML. Let's consider this example of applying the CAPM to determine whether these securities are under or overvalued. Suppose analysts have been following the above 5 shares that have the following current prices. They have forecasted the expected future price and the expected dividends, and hence the estimated rate of return calculated for each of the shares. For example, for share A, the return is calculated as $27 plus the dividend, $1.05, divided by the $25, the current price, everything minus 1. So 12.2% is the return of share A. And we follow the same calculation for all the other shares. Then in the second part of the table, they estimate betas on the regressions of the stock returns on the market using the historical sequence of returns. Now we assume that the economy's risk-free rate is 8% and the return on the market portfolio is 14%. This will provide us with a risk premium of 6%. Applying the SML equation, or CAPM, we calculate the required rate of return or the expected return for each share. So for share A, it's 12.2%. For share B is 14%. For share C is 14.9%, and so on. For each stock, this expected return or required rate of return is compared with the estimated return calculated in the top part of the table. So estimated return minus the required rate of return, and we can see whether the shares are correctly valued. We perform the evaluation and we find that share A is correctly valued, share B is overvalued, share C is undervalued, and so on for D and E. This is the graphical representation of that evaluation. So in the case of B and D, the estimated return is less than the required rate of return, is less than the CAPM, and therefore they will lie under the SML. So under the CAPM, given their level of market risk, these securities should lie on the SML. So they do not provide the adequate return. They should give more, but in fact they give less. So they are too expensive, they are overvalued. what happens is that investors will sell shares B and D, pushing the current price down, and as the price falls, the estimated return will rise until it plots on the SML. The same reasoning follows in reverse for securities lying above the SML, such as C and E. These securities are undervalued. Their estimated return is greater than the return provided by CAPM. So, based on the CAPM, they should give less, but in fact, they give more. They're above the line. They return a higher return than they should. So, they're too cheap. The investors will buy these shares because they're cheap, thus pushing the price up. Because of the demand, the price will go up. This process will continue until the estimated returns fall to be equal to the required rate of return and plots on the SML. Finally, share A is correctly valued. Its estimated return is equal to the required rate of return. Before we finish the module, we must briefly mention the efficiency of the capital markets. The financial market is one area that has been extensively researched by academics and practitioners. Why? Because of the potential gains and losses associated with investing in the financial markets. Welcome to the world of fear and greed, where money rules and profits mean power, and the more you have it, the greater is the desire to have even more. And the greater is the fear of losing it all. When Eugene Fama came up with the concept of efficient market hypothesis back in the 70s, it started a wave of research to determine whether the markets are indeed efficient or not. That research is still going and has sparked a huge debate. Some say the markets are efficient, some say they're not. We say the markets are efficient when prices reflect all available information, and you should not be able to earn excess or abnormal returns. This implies that you cannot use past data to predict or earn excess returns. So when markets are efficient, we say the market is informationally efficient. Prices are in equilibrium and you cannot earn abnormal or excess returns. For example, if a mining company suddenly announces that they found these huge reserves of metal, in an efficient market, that information will immediately cause prices to adjust upwards. And this is a representation of a stock price reaction to news and information. If the markets are inefficient, either there is a delayed reaction, it will take longer for the prices to adjust. This means that you can make a profit if you buy the share when the information is released and then sell it 1 week later at a profit when the prices have adjusted. Or there is an overreaction where the prices adjust more than it should, after which they correct to the appropriate level. If the markets are efficient, prices will adjust immediately without delay and adjust to the right level, no more, no less. What makes market efficient? Continuous research, liquidity, trading based on that research to enable the discovery of prices and allowing all the information to be assimilated. These days there is a lot of information out there, and it is important to remember that not all available information is reliable information. It's important to still do the research and not just jump on everything that crosses the news wire. One consequence of the wider availability of information and lower transaction costs is that the markets will be more volatile. What we have here is the graph on S&P 500 index at the time of the September 11 attack. The market closed on the 10th of September at the top of the chart, the top line. Before it opened again, the terrorist attack happened and the market didn't open for a week until the 17th. That's why we have a gap there. When the market did open eventually, the reaction to the event was instant, as we can see on the graph. We can see the huge drop in the market. Similarly, when Steve Jobs resigned as CEO of Apple back in 2011, it had an immediate impact on the share price, as we can see on the graph. We can say that in this particular instance, the markets were efficient somehow, as the information was immediately incorporated in the price. However, we don't know whether the level of adjustment was appropriate. Maybe the prices came down too much. We call that overreaction, or too little underreaction. Why do we care whether markets are efficient or not? If prices do fully reflect all information, then anything worthy you think you might know about the stock is useless, because that info is already incorporated in the price. If markets are inefficient and prices do not fully reflect all information, then that piece of information you possess might be useful in making a profit in the market. When we say that markets are efficient, we don't mean you can't make money. What we say is that based on the level of risk of your investment, you'll earn the appropriate return. If the markets are efficient, you can't make excess or abnormal returns. The relevant information is difficult and expensive to uncover and evaluate. Only a handful of people have the skill and resources to actually beat the markets and make a profit, the Warren Buffetts of this world. At the same time, just because the markets are efficient, it doesn't mean you can't lose your money if you make unwise decisions. If you invest in a stock just because you heard it from the taxi driver that ABC stock is a good buy because he heard it from a mate who has a friend who is a stockbroker, then you have no one to blame but yourself. This is not the way to invest. Or if you don't diversify and spread your money across different classes of assets. This concludes this module.